All right, today we're going to do a full financial health checkup on a company. We're going to look right past all the fancy marketing and the press releases and really dig into what the numbers are telling us about how healthy a business actually is. You know how it is. You see a company that just seems to be crushing it. Their products are everywhere, the ads are slick, but is it actually healthy on the inside? I mean, is it really making money? Can it pay its bills on time? How can you really know for sure? Well, that's precisely the question that financial statements are designed to answer. So here's the game plan for our checkup. First, we'll understand why we call these statements a health report. Then, we'll touch on the official rulebook that keeps everyone honest. After that, we dive into the three big tools: the financial X-ray, the performance review, and how we follow the cash. And finally, we'll see how to read the whole chart together. Okay, so what exactly is this health report? Well, in India, under the Companies Act of 2013, every single company has to prepare these financial accounts for each financial year. This isn't optional, it's a required, mandatory checkup on their financial condition. And if you remember one thing, let it be this: these are not just boring compliance documents. Not at all. They literally tell a story, just written in numbers. And once you learn to read them, you get what the law calls a true and fair view of a company's health, its performance, and maybe even a hint of where it's going next. Now, this complete health report has a few key parts. We're going to focus on the big three today. You've got the balance sheet, which is like our X-ray, then the profit and loss statement, that's the performance review, and the cash flow statement, which is kind of like a blood pressure monitor. And stick around, because we're also going to find out why the real secrets are often hidden in the doctor's detailed notes at the end. So you've probably noticed that if you look at a few of these reports, they all kind of look the same. Well, that's completely on purpose. There's an official rulebook in place, and it's there to make sure every diagnosis is consistent and reliable no matter which company you're looking at. And that rulebook has a name. It's called Schedule 3 of the Companies Act 2013. It lays out the exact format, the exact disclosures that every company has to use. And the whole point is to create reports that you can trust, that you can compare with other companies, and that give you that all-important true and fair view. Schedule 3 also introduced a really massive improvement. See, the old way was kind of clunky. You had these separate documents called schedules attached at the back for all the nitty-gritty details. The new way integrates all that info directly into what we call notes to accounts, making it so much easier to find the context right where you need it. All right, let's grab our first diagnostic tool. This is the financial X-ray, better known as the balance sheet. Now, the most critical thing to get about the balance sheet is that it's a snapshot. It shows you a company's financial position on one single day, usually the very last day of the financial year. At the heart of the balance sheet is this beautifully simple but really powerful equation. Assets, that's all the stuff the company owns, must equal its liabilities plus its equity. Or to put it another way, everything the company has was paid for with money it either borrowed, that's liabilities, or with money from its owners, that's equity. It's a perfect equation. It always has to balance. And the structure that Schedule 3 requires tells this story perfectly. You can see the top half shows equity and liabilities, basically where the company got its money from. The bottom half shows assets, what the company did with that money. The sources have to equal the uses, so those two totals at the end, they always match, down to the last paisa. And if we zoom in just a little, say on non-current assets, you start to see the company's foundation for future growth. This is where you find the physical stuff, like land and machinery, but also the really powerful intangible things, like brand value or software patents. It even shows you what the company is building for the future through its investments and unfinished projects. Let's move to our next tool, the performance review, or what we call the P&L statement. Now, if the balance sheet was a snapshot, I want you to think of the P&L as a video. It doesn't just show you one moment, it shows you the company's performance over a period of time, like the entire year. And the story it tells is actually incredibly straightforward. It's just 3 steps. Step 1, you start with all the money the company brought in the door. That's its total revenue. Step 2, you subtract everything it spent to make that happen: salaries, rent, materials, you name it. And step 3, what's left over at the very end, that's your net profit, or, of course, a loss. The official format follows this logic exactly. You see, it starts with revenue from its main business, adds any other income to get a total revenue, then it lists out all the expenses. You get a profit before tax, you subtract the tax expense, and there it is. The bottom line, profit or loss for the period. Ultimately, that's the number that answers the big question. Did this company actually make any money this year? Okay, our final big tool tracks the absolute lifeblood of any company, cash. This is the cash flow statement, and it is so important because profit on paper is not the same thing as actual cash in the bank. A company can look profitable and still go bankrupt because it just runs out of cash to pay its bills. This statement follows the real money. Now, to really understand the story of a company's cash, we break it down into 3 main categories. Why? Because this tells us how the company is getting and spending its cash. Is it from its actual day-to-day business? Or is it just selling off assets or borrowing money? These 3 slices tell the whole story. First up, operating activities. This is the big one. This is the cash that comes from the company's main business, what it actually does every day. A truly healthy company should, year after year, generate positive cash from its operations. Next, you have investing activities. This is all about the cash spent on, or maybe raised from, selling long-term assets, like a new factory or a piece of equipment. This section really gives you a window into the company's strategy for long-term growth. And finally, financing activities. This is simply about how a company raises money to fund itself. It's the cash that comes in from issuing shares or taking out loans, and the cash that goes out to repay debt or pay dividends to shareholders. So there we have it, our 3 key diagnostic tests. But just like any good doctor would tell you, you can't rely on just one test result. To get the full, complete picture of a company's health, you absolutely have to read the entire chart, and you have to look at it all together. And this right here is the real pro tip. The numbers you see in the main statements, they're just the headlines. The real story, the why behind those numbers, is almost always buried right here in the notes to accounts. This is the fine print. This is the doctor's detailed annotations. This is where the most valuable insights are usually hiding. And in the end, it all comes back to this one fundamental principle, straight from the law itself. The final accounts must give a true and fair view. That is the ultimate purpose of all of this. These reports are meant to be a clear, transparent window into the business, not a tool to hide things. So, now you have the tools. You know how to read the chart. You can look right past the splashy headlines and actually see the story that the numbers are telling. The only question left is, what stories are you going to uncover?